So let's have a look at Part B for Henry Limited 2021 flexible budgeting question that comes up in section 3. So Part B, we're given two options, option 1 and option 2. Option 1 says that modernization of the machinery. This will involve employing one new production supervisor at a cost of 40,000. So that's a fixed cost for the supervisor because that's how much their salary is going to be for the year or how long they're employing the company for. This will save €1.40 per unit in the production overhead. So our production overheads per unit is going to go down by €1.40. Now it's telling us here that it is currently operating at 100% at capacity and is considering two options. So if it's 100%, we need to find out how many units we're going to produce at 100%. So we're going to take the information up here like we did last time. So 95% is equal to 47,500. Sorry, yeah, 95% is equal to 47,500. 1% is equal to 47,500. Divide that by 95. So 1% is equal to 500, like we did last time. So 100% then is equal to 500 multiplied by 100. So that's going to give us 50,000. So that's how many units we're going to produce at 90%. So we're going to use the marginal costing principle. So we know the marginal costing principle is going to be sales less your variable cost. And we know from this question, variable cost is made up of direct materials. It's made up of direct wages. It's made up of production overheads. Made up of other overheads. That's going to give you a contribution. Then you're going to less your fixed costs. And we know that they're made up of admin. They're also made up of production overheads from part A1 and other overheads from part A2. So a couple of things we can do here. We know that our fixed costs, so we can take this, we have this already calculated from part A3. So it's the same layout and we calculate €5.50 for our variable cost for materials, €6.70 for the variable cost for direct labour, production overheads €4.40 and other overhead units €5.25, and they're going to be multiplied by the units. So we've calculated the units here to be 50,000. So our fixed cost then, administration, is going to be 38,500. Other overheads 6,500, and our production overheads at the moment is 8,000. But if we look at this scenario that they're telling us here, option 1, it's telling us that employing one new production supervisor. So that means that our production overheads are going to go up by 40,000. So we'll put them in now. So you got your administration, which is 38,500. Then you got your production overheads, which is the 8,000 plus the 40,000. And then other overheads then, so see here, this is your production overheads, 8,000, 40,000 is taken from here. And your other overheads, 6,500. So you can add these up to get the total for fixed costs. Now we know that we are got 50,000 units, and that 50,000 units going to be multiplied by direct material €5.50. Now this one here, this will save €1.40 per unit in production overheads. Our production overheads per unit at the moment is €4.40. So if we're going to say €1.40, we're going to take €1.40 away from €4.40 to see that'll give us your new variable cost per unit. So direct material €5.50 multiplied by 50,000. Your direct wages going to be 50,000 again, multiplied by the variable cost per unit, direct labour, direct wages, which is €6.70. Then you got your production overheads. Now remember, production overheads are going down by €1.40, so it's 50,000. Multiply that by €4.40, so it's multiplied by €3. So €4.40 take away €1.40 will give you €3. And then you got your other overheads then, 50,000 multiplied by €5.25. So let's find out what we get for each one of these. So 50,000, multiply that by €5.50. 50,000, multiply that by €6.70. 50,000, multiply by €3. And then 50,000 multiplied by €5.25. And we're going to do the same again. We're going to add up all our variable costs to get a total. So these two figures, so it tells us here that our profit is worth 20%, sales is worth 100%, so that means that the variable cost and the fixed cost added together will be worth 80%. So this is going to help us calculate the contribution. So 80% is equal to 1,225,000 plus 93,000. So 1% is equal to 1,115,500 divided by 80. Same as then 100%. It's equal to this, multiplied by 100. So your 100% that's going to be 1,394,375. So that's going to go for your sales. You're going to take your variable cost away from your sales to give your contribution, and then you're going to take your fixed cost away from contribution to give your profit. So in option 1, we're going to make a profit of 278,875. Okay, so that's option 1 done. So remember, you're going to use the same layout as we did in part A3. The only thing that's going to be different is that the variable cost per unit is going to be changed as per the question. So we know here your production overheads went down by €1.40. Your fixed production overheads then went up by 40,000. It's the same again. You're going to get your variable cost and your fixed cost. That's worth 80%. So that's going to help you calculate what is 100%. Then 100% take away your variable cost will give you contribution. Contribution take away your fixed cost will give you a profit. And that's option 1 complete. Now we do the same thing for option 2, taking into consideration what information are given us in the question.